Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate a consistent return year on year. So we're going to be writing options contracts or selling options contracts. Those terms are interchangeable, so of course we're going to need to know where we are in the option cycle. So what we want to do is just pull up any equity, say BA, that's fine. And then we want to open up a list of expirations that are available for that underlying. So as you can see here, we've got two types of expirations available: weeklies with an orange W, and then everything else is a monthly. So we want to stick with a monthly expiration. And where in the cycle do we want to go? We want to be between 30 and 60 days out in time. 45 days is perfect, but again, we not at the expense of being at a weekly, so we only want to stick with the monthlies. So the next monthly available is October 18th. That's 7 days away. That's far too close. We need to be at least 30 days out. So we're going to go to the next one down, which is November 15th, and that is 35 days out in time. It is a little bit short, but it's fine because the next one down further out from there is December 20th, and that's 70 days out, and that is a little bit too far. So 35 days would be the optimal duration for where we are currently in the option cycle. So now that we have this information, 35 days, we can take that information, come over to your watch list. You can just use any watch list. It really doesn't matter. Let's just use a different watch list here. And what we want to do is we want to filter out any underlying that has earnings over that next 35-day period. And the reason for this is because if we're going to be in a contract for the next 35 days, we don't want earnings to come along and mess things up, because earnings will almost definitely increase volatility and mess up your deltas, and this is going to have a negative effect on your P&L. So you want to filter out things that have earnings, and you also want to filter out anything that has a low liquidity level. The reason for that is because you want to be able to trade tight spreads and get in and out of positions pretty easily. So once you've done that, you'll be left with a watch list full of things that is very liquid, that are very liquid, sorry, and also don't have earnings over the selected period. Finally, all that's left to do is sort everything from high IVR to low IVR. IVR is implied volatility rank. We want to sell our contracts when IV is high and play the contraction back down to the mean and potentially lower. And IVR is one way that we can tell where implied volatility is with respect to itself over the past year or so. So if we go down the list, we can see we've got CCEP, JCI, Dollar Tree, DAL, AMAT. We've got some nice underlyings here to choose from. Typically, we want anything with an IV rank of 50 or more is considered high. Anything below that is considered low. However, there can be times where something above 30 can be considered high. It just depends on what the current market conditions are. But generally speaking, over 50 is good. And before we do actually select something to look at, you want to keep in mind what's already in your portfolio. If you've already got active positions on, then you need to keep in mind what you've already got positions on and then pick something that's going to complement it, i.e., that's going to add some diversification to your portfolio. You don't want to be too heavy in any one sector or anything like that. You want to make sure you're nicely non-correlated across all of your positions as best as possible. And if you don't have any positions on, then you're in a nice position. You can basically do what you want at this point. So we've got DAL, AMAT with a IV rank of 58.1, PDD, AVGO. I do like trading AVGO. We've got MU, Walmart. We are starting to drop in terms of the IV rank, so I think we'll just come up a little bit, and I think the cutoff point here will be AVGO. By all means, let's just have a look at Dollar Tree. We haven't actually mocked up a position on Dollar Tree, I don't believe yet, and it has got a very nice IV rank. It's trading currently at just under $70. The market is closed. This is pre-market. Let's just have a look at the chart. So as we can see here, IV rank has been higher. We have had this little drop off here. Market has gapped down a little bit, and I don't think that this is a bad this would be a bad trade. I think definitely there probably are better opportunities. If we just go to AVGO, have a look at what's happening with AVGO. Again, there probably are better opportunities, and you want to also see where IV rank is relative to itself, because as you can see here, we've got an anomaly up here which does skew the graph slightly. So if you do get anomalies, what you can do is you can just filter out the highs, and then what you'll be left with is just the lows, and it'll be a little bit easier to see if you have got anomalies in there like that. We can have a look at AMAT. AMAT, as you can see here, we have actually mocked up a position before. And as you can see, the position that we mocked up, price has respected our strikes. AMAT is actually really nice to trade. I think let's go with AMAT. If it isn't broke, don't fix it. So this is what AMAT looks like. We've got an IV rank of 58.1. It could be better. However, I like the way that AMAT moves. It's pretty manageable in my opinion. So we're going to go with AMAT, and we already know we're going to be at the November 15th expiration, 35 days out in time. It does have earnings on November 21st, but we are going to plan to be out of this position well before November 15th. So we open up November 15th, and now we are presented with the options chain. And just to give you a rundown of what is happening, we've got an horizontal orange bar here that shows you where price currently is with respect to the strikes. As we can see, it's currently trading at about $203.50, which is right in between 200 and 210. And then we've also got this vertical orange bar here that shows you what the expected move is of AMAT over the next 35 days. So now we need to figure out how are we going to make money from this situation. Right now it just looks like there's a bunch of numbers everywhere. So we need to sell something to bring some money in. So what are we going to sell, and where are we going to sell it? Well, there's two types of contracts that we can sell, calls and puts. We're going to keep it very simple. We're going to sell one call and one put. And where are we going to sell these contracts? Well, we want a high probability of success. And so in order to achieve that, we're going to need to sell these contracts outside of the expected move somewhere. Typically, I like to go anywhere between a 15 and 20 delta. So if you look on the delta column for the call contracts, we've got a 13 delta, and then the next one up from that is 22. So in this situation, I would be tempted to go with the 22 delta as opposed to the 13 delta. And then on the put side, we can go a little bit lighter and go with the 15 delta if you wanted to. That will give us an overall -6 deltas, nearly -7 deltas on the overall position. If you wanted to tighten that up a little bit, by all means, you could just go with the 19 delta, and then you will be slightly more delta neutral on that position. So this is what the position looks like. We've got a 19 delta on one side, 22 delta on the other side. And as you can see, our contracts have landed very nicely just outside the expected move. The further outside the expected move you go, the less premium you will collect. So it is a bit of a balancing act to get it right and get the most bang for your buck. So if we were to just plot this on a graph and see what's actually happening here, we would need to mark out price levels at our strikes, which would be at 180 and 230. So 180 and 230 would put us there. So this is where our strikes would be, and essentially what we've done here is we've created a range for ourselves. Now, if we were to put this position on, the market's going to start moving, and what does that mean for us? So we want price to stay within this range, okay? And more specifically, we want price to be within this range at expiration, which is 35 days out in time. And if that happens, then both of these contracts will expire worthless because they will both be out of the money, and we will be able to keep all of the premium that we collect up front. So what is the premium that we collect up front? That is what this number down here is. It's currently it's at 6.66, which is $666 because there's 100 shares per contract. So this will be $6.66 per share times 100. You get your max profit of 666. So you'd collect $666 up front, and our broker is going to require just over $2,000 in buying power to open this position. Now, this is a very nice return on capital trade, especially for a naked position. Naked meaning that there's nothing covering our shorts, i.e., we have a max loss potential. Now, this might seem scary. However, if you do go in some of our other previous videos, we can show you how to manage risk, and you won't actually realize a max loss as long as you do everything correctly, or unlimited max loss, I should say. And speaking of which, what is the actual chance of this position going wrong? So with our strikes being outside of the expected move, we're expecting to have a high probability trade. A high probability trade is anything over 50%, and currently we'd have a probability of profit of 68% on this trade. So very, very high probability. And if you wanted to not keep max profit, but keep 50% of max profit, so 333 instead of 666, then we've got an 80% chance of hitting that at some point over the next 35 days. So you've got somewhere between a 68 and 80% chance of being successful on this trade. This is a very high probability trade, and it also gives you a nice return on capital as well. And it will give you a nearly $24 in daily theta decay. And that's today. Assuming all things equal as time goes on, this theta decay will get increasingly more aggressive. So some of you might be thinking $2,000 is a lot of money to allocate to just one position, and I hear you. So if that is an issue for you, then what you can do is simply buy some contracts a little bit further out from the ones that you're selling, to cover yourself. So what that will look like is something as follows. So we've got a call contract at 230. So the next strike further out is at 240, which is $10 wide. So we can do the same thing on the put side. So 180, we go down to 170, $10 wide. And what that's done is it's essentially created a spread on both sides. That's the same width wide, $10 on either side. And if you notice now, we no longer have a unlimited max loss potential. Our max loss is now actually defined. And how do we get this max loss number? Well, our max risk is essentially whatever the spread is between these two contracts. So the green contract is the one that we're going to buy, and the red contract is the one that we're going to sell. So the amount of money that you can lose is the difference between these two contracts, which is $10 per share. Now, we also collect a premium up front of $2.93. So it would be $10 minus $2.93, and that's how we would get to this max loss, because once we collect the premium, we never have to pay the premium back. We may have to buy the contract back at, say, a higher price if the position goes against us. However, we would still keep the premium up front. So it always comes off our max risk. And if this was a naked position, it would be added on to our break-even points to make our break-even points wider, and that will give us an even higher probability of success. So this is how you can find positions and how you can manipulate positions to fit your portfolio. You do need to also keep in mind the size of your positions, because it doesn't matter what you do, if your sizing is wrong, eventually it won't end well for you. So we've put together this position sizing template that's free for everybody to use and get a hold of. And the way it works is you enter in the size of your portfolio. Let's say if it's $5,000. Below that, you can then enter in the current VIX level. Let's just say if it's 22.3. Everything below will then be automatically calculated for you. And at this point, all you need to do is use the information here to form the backbone of your portfolio. It will tell you how much buying power to allocate to undefined risk positions, defined risk positions, how much of your portfolio you should allocate to short premium strategies in general. And as long as you follow this, you'll be absolutely fine. It's free for everyone to use and get a copy of for yourself. just click the link in the description, head on over to the free position sizing template, and that will take you to where you need to go. If you want to get some more support and copy our positions and make money with us, and also get access to a full course, again, click the link in the description, head over to EDS Premium, get yourself signed up, and once you're in, you'll have access to our portfolios. You'll be able to see what positions we're putting on, when we're putting them on live in real time, any adjustments that we're making, so you can see what kind of positions we're putting on, how we're managing them. And then by all means, if you want to just simply copy us whilst you know learn the ropes, that's absolutely fine. Either way, there's a full course inside anyway if you choose to do it yourself, so no prior knowledge is required. We'll teach you everything you need to know. It's a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. And there's a 100% money back guarantee. So once you've studied everything and followed our trades for 6 months, and if you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. And right now it's £1 a month. The price will be increasing, but once you're in, you don't need to worry about any price increases. You're locked in as long as you don't cancel. And with that being said, I will see you guys on the inside.